final time, thanks everyone for joining us today for our webinar, COBRA Rules and Common Errors. My name is Matt Sans Regret, and I'm Vice President of Sales here at Payroll Systems. So a couple things. So first and foremost, we'll have everybody muted for the presentation today. So feel free to make as much noise as you need to make. If you're enjoying the webinar from the comforts of your home, don't worry about the doorbell ringing, dogs barking, any of that other fun stuff that we all love in our online meetings. We do want to make the webinar very interactive though. So please familiarize yourselves with the webinar software, specifically the chat feature. And you can post questions during the webinar. We'll either try to address those questions during the webinar, or we're saving some time at the end of the presentation to also go through those. Just to let you know, I've posted the presentation today as an attachment for the webinar, so you can look at the handout section of the webinar software and feel free to grab the actual presentation and download it. It's just a PDF file. And we will be making a full recording, and all audience members will get a notification that that full recording is available. That should happen by the end of today. Okay, so in the interest of everybody's time, and once again, thanks for everybody for attending. Let's go ahead and get rolling. As I mentioned, this is Matt Sans Regret. I'm Vice President of Sales here at Payroll Systems. For anyone not familiar with payroll systems, we do a lot more than payroll. We've been a leader in services such as time and attendance, consumer-directed healthcare plan administration, human capital management software or HRIS platforms, and certainly payroll. And we've been doing it for about 30 years now. Today, I'm very pleased to introduce our guest speaker, and that's Terry McCorvey. Terry has a wealth of experience. Hey, Terry. Good to see you. I'm going to give you a proper introduction.
Yeah,
here.
Good to be here.
Right on. So Terry has a ton of experience on our topic of COBRA. We're real thankful he can join us. Terry founded a company called Workable Solutions in Orlando, Florida. They're a third-party administrator about 20 years ago. And prior to that, he was an executive director of a health purchasing exchange and a hospital administrator. Terry has 15 years experience administering COBRA for thousands of employer clients. He's now semi-retired and does benefit consulting around the country. So Terry, welcome again, and looking forward to the presentation.
Wonderful. Thank you, Matt.
So why don't I go ahead and review the agenda, and then we'll turn it over and get started.
Great.
So for today, obviously we want to keep this to about 30 or 40 minutes total, and our goal is to just give a nice overview on the topic of COBRA. Hopefully this will stimulate some questions for you. We can address those today. We're always happy to follow up with the conversation down the road. We'll be certainly posting our contact information for both Payroll Systems as well as Terry for any other follow-up questions. We want to talk about the typical qualifying events for COBRA, both the obvious ones as well as the ones that are commonly missed. We'll go over timelines for offering and administering plans. Certainly want to talk about how to avoid some of the common mistakes that we see as an administrator on a regular basis. Want to talk about hidden costs of administering plans, and also touch base on what's going on in Washington a little bit. So with that, I think I'm going to turn it over to Terry and let you go ahead and get started.
Wonderful. I do appreciate everybody coming. I know COBRA is probably not at the very top of your list of exciting topics, but hopefully for the next 30 or 40 minutes, we'll give you enough to keep it interesting. So, and try to steer you clear too of some of the common pitfalls and mistakes, because quite frankly, 90% of COBRA is kind of black and white, but the other 10% can get you in trouble if you're not careful. So we all know, I think, probably, that COBRA stands for the Consolidated Omnibus Budget Reconciliation Act. But I'm wondering if you know when COBRA actually became law. And that's a little bit of a trick question because Congress actually passed it back in 1985 through a budget reconciliation process, really a very similar process to what we went through with the Affordable Care Act more recently. But it didn't actually become law until President Reagan signed it in early 1986. People always say, oh, I have COBRA insurance, but of course they don't have COBRA insurance. What they've got is simply the right to continue the group coverage they had on the day before their qualifying event. And which employers have to offer COBRA? Well, private employers who had more than 20 employees on 50% of the typical business days during the previous calendar year. If they fall in that bucket, then they're an employer that has to offer COBRA. And it sounds like a typical government formula, and it is. Now, the employee count is based on full-time equivalents, or FTEs. So part-timers are included as a fraction of a full-time person, and this applies to state and local governments too. And COBRA really is about timely notices that contain all the required language, and there are a lot of timelines to pay attention to, those language requirements. There's payment deadlines and grace periods, so we'll go over all that. And remember too, most states also have a separate mini COBRA law that applies to employers who fall below that 20 category. Now, COBRA doesn't just apply to your medical plan. Even flexible spending accounts and health reimbursement arrangements are also typically subject to COBRA. Life insurance and disability are not COBRA eligible, but dental and vision are. And if you offer a wellness plan, it might be. And I'll talk about that a little later, which wellness plans actually might fall under COBRA. So first of all, let's dive into exactly who has to offer COBRA continuation. We said employers with 20 or more FTEs on 50% of the business days in the previous calendar year have to offer it. We also said part-time employees count. And that means if you've got paid interns, they count. Now, COBRA does not apply to the federal government or to most church organizations. So they have their own solution in the federal government. And the law says that the COBRA administrator can charge typically 102% of premium if the qualified beneficiary does qualify for a disability continuation. And we'll talk more about that a little later. Then the administrative fee goes way up to 150% of premium. So let's talk about those FTEs and how you figure out if you are a COBRA eligible employer or not. We're going to take an example here because we want to be careful, because in typical Uncle Sam fashion, there's a different calculation for FTEs when it comes to COBRA as compared to the calculation you use for the Affordable Care Act. So let's say we got a business here, and they define a full-time employee as someone who works 40 hours a week. And they've got 14 full-time employees. So at first glance here, you might think, well, they're not a COBRA eligible company because they've only got 14 full-time people. But wait, they've also got 10 part-timers. And on average, those part-timers work 25 hours per week. Some might work 15, some might work 27, but on average, throughout the year, they work 25 hours a week. So how do we figure out how many full-time equivalents are represented by those part-timers? Well, we take the 10 part-timers times the 25 hours they work, and that comes out to 250 hours. We divide those 250 hours by 40 hours, which is the definition of a full-time person. and that gives us 6.25 employees, or FTEs. So if you add the 14 full-time to those 6.25 FTEs, that's 20.25 FTEs, and so they just squeaked in. They're barely over the threshold, and they are subject to COBRA for the current calendar year. Now, I said the current calendar year. That's important because the calculation you did on last year applies to the entire current calendar year. So if you hire more employees and you're not subject to COBRA, you won't be subject to COBRA until the following calendar year. But conversely, if you drop below that 20 employee threshold, you're still subject to COBRA for the remainder of the current calendar year. And in doing this calculation, you have to count all the employees. You're not just counting the plan participants, not just the enrollments, you're counting the entire employee population. Now, depending on the corporate structure, you wouldn't count self-employed people or independent contractors you might work with. And again, depending on the corporate structure, a director of a corporation typically may not be counted. So let's move on.
Hey, Terry,
let's talk about
you kind of answer this, but we've got a question coming in. So, and we deal with this as an administrator as well. Is this concept of, okay, I'm at 20 or 25 or 30, and then my count does drop. Are you saying that then you need to reconcile that at the end of the year to determine what it's going to be for the following year? At what point do you decide, for the next calendar year if you're going to be required to offer COBRA or not?
Yeah, the qualification for COBRA eligibility basically is January 1st of every year. So on January 1st or January 2nd, you would look back on the previous calendar year, you would do the exact calculation we just illustrated, and you would come up with whether or not for the current calendar year, you're going to be a COBRA eligible employer. As I said, that then, just like Section 125, that then stays in place for the entire 12 months of that calendar year until you do the same calculation the following first week of January and determine whether or not you remain COBRA eligible or you're a newly COBRA eligible employer.
Got it. And then
so let's talk about.
Go ahead.
Of course.
I'll let you proceed on, and we can actually this would be a good one because I think you alluded to this, but a question came in just to clarify the fact that the COBRA full-time equivalent definition is in fact different than the ACA full-time equivalent definition. Can you maybe clarify that or comment on that, the 30 hours versus 40 hours?
Yeah, it is different because it, number one, takes the employer definition of a full-time employee, and then it's an average. So remember, it's only the threshold is you have to meet the COBRA eligibility on 50% of the typical business days. So the calculation is different, and it's an average of the hours worked. Of course, it'd be much easier, I guess, if the federal government said it will have the same calculation for all of our FTE requirements, but no, that's not the way it worked. So, yep, it is different. So let's talk a little bit about what plans are subject to COBRA. And of course, we all know our medical plan is going to be subject to COBRA, and that is whether it's a traditional fully insured plan or a self-insured plan. And it makes sense that certain other plans would also fall under COBRA, like dental and vision and prescription drug plans. I mentioned earlier HRAs and flexible spending accounts, although both of those have some special rules around them. What you might not think of is if you've got a wellness program that actually provides medical care, then that's going to fall under COBRA too, or an employee assistance plan that also includes a medical care component. That could, in the case of either, could be an on-site clinic or could be the ability for addiction, counseling or mental health. So you need to carefully look at those programs if you're offering them. If it's simply an educational component and a discounted gym membership, then no. But if there is a medical care component, then they're likely going to fall under COBRA. There's a lot of stuff also that doesn't. Health savings accounts are not subject to COBRA, long-term care plans, accidental death and dismembership, life insurance, long-term and short-term disability, dependent care, flexible spending accounts, and of course EAPs and wellness plans that don't have that vital medical care component.
Terry, quick comment on this came in regarding dental and vision. Question is, are they mandated to offer, referring to dental and vision, or is this just an employer choice to do so or not?
No, if you offer a dental and vision plan, they are COBRA, subject to COBRA. And when you send out those notices, the dental and vision options have to be included along with your medical plan. Now, again, for those premiums attached to the various tiers for dental and vision, you can charge the 102% of premium. And it only has to be offered, remember, if they were enrolled in the dental and vision plan on the day before the qualifying event. So if they weren't enrolled in dental and vision and they have a qualifying event, then no. They don't have the ability to enroll in dental and vision until the following open enrollment period if they weren't enrolled in them the day before the qualifying event.
Which is basically the same rules if they were an active employee, right? Typically. Exactly.
Yep. So let's talk about qualifying events for a minute, because there are a bunch. There are those that affect typically the employee and those that are reserved strictly for dependents. And normally they're going to fall in one of two buckets. Either it's going to be an 18-month period of eligibility or a 36-month period of eligibility. So if there's a termination or reduction of employee hours, that is almost always going to be a qualifying event if they were enrolled in the medical plan. And so it applies to any employee who terminates for any reason other than gross misconduct. I used to think that if an employee just quit, well, then they weren't eligible for COBRA, but that's not true. If an employee does quit voluntarily or is terminated for cause, in both cases, they are eligible for COBRA and have to receive a notice. And also, if the employee's hours are reduced so that he or she is no longer eligible for the group medical plan, that's a qualifying event for them too. And by the way, let's talk for a second about gross misconduct, because the definition of gross misconduct for COBRA is it has to be related to the employer. So unless an employee's intentional actions have a negative impact on you as the employer, and the employee knew or should have known that the employer would suffer as a result of their actions, then this gross misconduct exception does not apply. And quite frankly, a lot of employers I work with simply say, you know what, we're not going to get in the business of deciding whether it was real gross misconduct or not. We know if the employee disagrees with us, it's probably going to end up in federal court. That's going to cost money. So an awful lot of employers just say, you know what, if there was a qualifying event, if an employee was terminated, we're going to offer them the COBRA notices regardless. We're not going to use the gross misconduct exception. So in certain circumstances, excuse me, qualified beneficiaries who are normally only entitled to 18 months of COBRA may be entitled to a disability extension of another 11 months. So that would be a total of 29 months. There's a lot of rules around that disability extension. It's got to happen fairly early when they're on the COBRA continuation. But people do qualify for that extension all the time. and it's an additional 11 months for a total of that 29 months. Also, if a qualified beneficiary is already on COBRA and they have a second qualifying event that occurs while they're on continuation, then they can have an additional 18 months for a maximum total of 36 months. And an example of a second qualifying event might be when a terminated employee elects COBRA but then becomes eligible for Medicare, and so that would trigger an additional 18 months for the dependents. And speaking of dependents, most of the other events are related to dependents. For example, if Medicare entitlement results in a loss of coverage for the retiree's family, then his family has to be covered for 36 months of COBRA from the date of that Medicare entitlement. But note, the Medicare entitlement as an initial qualifying event for COBRA only affects spouses and dependent children. So please note, a covered employee's entitlement to Medicare is never a qualifying event for the employee because there was no loss of coverage for the employee. I mean, obviously the death of a covered employee would leave the dependents without active coverage, and that would be a COBRA qualifying event. A divorce normally would create a qualifying event for the spouse, but not for the employee. And again, the spouse may have coverage through another employer and would choose to go that option. But it also could leave the spouse through divorce or, in some states, legal separation, finding themselves without coverage. Now, this is important. To become a qualified beneficiary, there are two litmus tests. Number one, they must have been covered by the plan on the day before the qualifying event. And number two, the event has to result in a loss of coverage. Without a loss of coverage and without them being covered on the day before the event, there is no qualifying event. Now, there is one final qualifying event that applies typically to retiree health plans. They're not exempt from COBRA. And the COBRA rules include a special qualifying event rule under which a bankrupt employer is required to offer retirees and their dependents the right to continue health coverage under COBRA if the retiree medical coverage is either substantially reduced or eliminated within a year of the time that employer files for bankruptcy. And that's one that's sometimes overlooked. There's a lot of other rules regarding COBRA and acquisitions and bankruptcies we're not going to go into. But one question I do hear a lot is, how long does an employee have to have been on our group plan to qualify for COBRA? Is there any kind of a 90-day rule where they're on probation? And the answer is no. They could be on your group health plan for as little as 1 day. And if that day just happens to be the day before a qualifying event, they do become a COBRA eligible person. All right, let's move on to flexible spending accounts and health reimbursement arrangements, because the rules for COBRA are a little bit different. Now, first of all, you might ask yourself, why would a medical FSA participant even want to elect COBRA in the first place, since any contributions they're going to make after their termination are not deductible and there's no tax advantage? Well, here's one scenario where it might make sense. And that is if a FSA participant wants to maintain their eligibility so they can make claims against previous employee contributions that have not yet been reimbursed or spent. And that spent is a really important word, because when it comes to an FSA, COBRA only applies and only has to be offered to an FSA which is underspent. And what underspent means is that the amount available for reimbursement for the remainder of the plan year is more than what the COBRA premium would be for that period. So let's look at an example. We said there has to be a positive balance. In this example, let's say we have a calendar year plan and the qualified beneficiary is terminated on July 1st. Well, in this example, the employee elected $2,500 for the current plan year. But this employer also offered a $500 carryover from the previous plan year. And so as of the date of her qualifying event, she actually had been reimbursed for $1,100 of her $2,500 election. And on the day before her election, she had contributed July 1st, so she had $2,500, so she put in half, or $1,250. So doing the math here, the maximum benefit she's entitled to receive for the remainder of the year, including that $500 she carried over, is her $2,500 election, the $500 carryover minus the $1,100 she's already used, leaving her $1,900. So how do we figure out the premium, the monthly premium for that $1,900? Well, we don't include the amounts carried over from the previous year. We don't include that $500 because that wasn't a contribution in the current plan year. So she elected $2,500 for this plan year. We know she spent $1,250. So there's 6 months left in the year. So her premium would be $212.50, but oh, wait a minute, that includes the 2%. So that's important. We do include the 2%, even though it's a flexible spending account premium. So actually, in effect, her 6-month premium for the remainder of the year is $1,275, which is less than the benefit she has. And so therefore, the FSA is underspent. And it may make sense for this particular person to elect COBRA.
This math sounds like a good sales pitch to outsource your COBRA to a third-party administrator.
Let's talk about HRAs for a second because they're no less complex. So what is the applicable premium under an HRA? Because the federal government says you cannot base the premium on whatever's left available in this individual's HRA account. That'd be way too easy. So they say that there are 2 methods that they will approve for determining the HRA COBRA premium. One is the past cost method, and we define past cost as the actual plan utilization plus the administrative fees, or you can use the actuarial method. So we all know an HRA is going to be integrated with the employer's medical plan. So obviously only employees, spouses, and dependents who were enrolled in the company's medical plan are going to qualify for COBRA or an HRA. So if we use the past cost method, that refers to HRA plans which were in effect the previous plan year, and there's no significant design changes in the plan this year. So if we take the total claims experience from the prior plan year as a percentage of the maximum available liability made available by that employer, and then we divide that number into a monthly amount, then the employer can determine the actual cost, the actual liability, the actual dollars spent for similarly situated beneficiaries during the previous plan year. Now, they can adjust for any increase or decrease in the cost of living, and then they use that to determine a monthly premium. And that can be divided by tier. If you're offering a different amount of HRA reimbursement or available money based on the coverage tier, then the same thing applies. But you can't say it's going to be 100% of the cost. It's going to have to be more like looking at the actual exposure and the utilization and coming up with that past cost method. Now, the other method is called the actuarial method, and that has to be used when it's a new plan or when there were some pretty substantial changes made in the design of the plan. And it doesn't mean you have to run out and hire an actuary because they're expensive. But you do have to go through some due diligence to figure out what is a reasonable premium. And I can tell you the IRS will tell you 100% of the available benefit is simply not reasonable premium. What you have to do is look at your plan design, because the plan design in part will determine the premium. So let's say the HRA only pays, for example, post-deductible expenses. Well, utilization then is not going to be nearly as high as if the plan paid all 213D expenses. So for a post-deductible plan, a reasonable premium might be 30% of the total available benefit. But for a plan that pays all 213D expenses, it might be more like 70% of the available benefit. Now again, you can add on a 2% administrative fee, and I'll tell you, in reality, a lot of employers rely on their broker or their administrator or their insurance carrier to give them the idea of what should the premium for an HRA be. And I can tell you the IRS has never issued final regulations that govern this topic. And so typically what the IRS says is if you've made a good faith effort to be fair and come up with a reasonable premium using the past cost method or the actuarial method, then you're going to keep out of harm's way. We're not going to worry. It's only when an employer willfully tries to get around these two methods that there might be issues. All right, let's move on into the required notifications. The first notice is called the general notice. Sometimes we refer to it as the initial notice. And that informs employees and their spouse, if their spouse is covered, of their rights under COBRA. And it has to be sent, this is important, within 90 days of the date they enroll in the plan. And that includes sending the notice when your company first becomes subject to COBRA. So if last year you weren't a COBRA eligible company and this year you are, then every single employee who signs up for your plan has to receive this notice. And a lot of employers forget that. It also has to be sent when a dependent is added to coverage, upon marriage or open enrollment. Also when there's a mid-year qualifying event, or open enrollment when a previously waived employee decides they're going to enroll for this plan year. Each of those requires the trigger of sending this general notice. And just as an aside, a lot of employers assume that the notice requirement, that initial notice requirement, is going to be covered by their insurance carrier when they send out their summary plan description. But I can tell you, a lot of times the summary plan description that's sent out by your carrier just doesn't have all the required language. So I always say opt on the side of caution, send out the notice unless you can get written confirmation from your carrier that their summary plan description also covers all the general notice language. One other thing, all of these notices also have to be addressed to the employee's spouse if he or she is covered under the plan, and they should be sent first class mail. You want to make sure you keep a log of all the letters sent and dates. And in some cases, you may want to obtain a certificate of mailing. And that's simply the post office acknowledging, yes, that you dropped off these notices. One thing though.
Hey, Terry, question here.
Yeah.
This is good policy. What happens if an employer discovers they did not send a general rights notice where they've missed their deadlines? What would be a best practice in that case? Best practice is print that letter out in the next 2 minutes and mail it. It really is. If you haven't yet had a qualifying event for that person, then thank your lucky stars and send a notice. If there is a qualifying event and they weren't properly notified, and they fall outside of some of these timelines,
that we're discussing, they could have a legitimate case for saying, well, you never told me my timelines through the initial notice, so how was I supposed to know? And in that case, you may find yourself in a situation where even though they're outside of the prescribed timelines, you still have to make, COBRA available if they make the election. So, but yeah, the best thing is if you discover it, just print it out and mail it.
Got it.
Don't send it though certified mail, because a return receipt from the post office with no delivery acceptance signature provides proof that the qualified beneficiary did not receive their notice. And so you want to make sure that when push comes to shove, you as the employer made your best effort to mail it to them at the last known mailing address. But you don't want a certified lack of signature to come up and bite you. So moving on to the election notice. This is sometimes called the specific rights notice, because this is the notice you send when there is a qualifying event. It details all the options available to the qualified beneficiary. It's lengthy. It outlines all the timelines for election and making payment and all the plans available and their associated premiums, including that 2% administrative fee. And we're going to talk more about the timelines for what happens when a qualified beneficiary receives that notice here in just a second. Before that, I want to talk about two less often used notices. One is called the unavailability of coverage notice, and that has to be sent when COBRA is not going to be made available. If you determine the individual isn't qualified for COBRA, if there wasn't a qualifying event, then you have to send this notice saying that, in effect, we've made a determination that there was no qualifying event, and so you are not available. Also could occur when they move outside of your coverage area and there's no plan available in that coverage area. So it's simply a notice advising that you may have had a qualifying event, or you may have thought you had a qualifying event, but COBRA coverage is not going to be made available to you. And then the other one is early termination of coverage. And that simply has to be sent anytime coverage ends before the end of their 18-month, 29-month, or 36-month period of eligibility. For example, if you term a participant for non-payment, he's got to get this notice. Or in the event the employer is no longer offering group health insurance, they've got to get this notice. So let's move on to some of the timelines that are involved here. And a part of what causes problems with COBRA is the law allows, believe it or not, up to 149 days before a qualified beneficiary is required to actually pay their initial premium. But the coverage is always retroactive back to the day they lost their coverage. So that can result in confusion. Carriers don't like it. They don't like reinstating people without premium, so they typically put them in a pending status, and that means if there are claims during that interim period, those claims are in limbo. It just causes a lot of confusion. But here's how it works, like it or not. You as the employer have 30 days to notify the plan administrator, and once the plan administrator is notified, they have up to 14 days to actually send the notice. So who's the plan administrator? Well, normally the plan administrator is going to be the employer. So if you're the plan administrator, actually you can take up to 44 days to send that notice. I wouldn't recommend it, but you can. In reality, you should send it as soon as possible after the qualifying event. If you outsource your COBRA administration to payroll systems, you have to notify them within 30 days, and they have 14 days then to mail the notice. And by the way, the timelines run from the date of the qualifying event or the date of the actual loss of coverage, whichever date is later. Now, in the event of a qualifying event for a dependent, they actually have 60 days to notify you as the plan administrator. And you might wonder why do they have such a long time? Well, many of these qualifying events are traumatic events. You know, there's a death or divorce or some other event. And so the federal government said, we're going to be nice with all those emotions and all of the other things they've got to worry about. We're going to give them a 60-day period to actually notify their spouse's employer or their parent's employer that there was a qualifying event. So then the qualified beneficiary has 60 days after their notice is postmarked to decide if they want to elect continuation coverage. It's determined again by the later the date they lost coverage or the date the notice was sent. So in this case, a lot of people have figured out, well, you know what? I'm going to elect coverage just to protect myself because I know I've got, on the next bullet point, 45 more days before I got to make any payments. So I think I'm going to go ahead and elect COBRA. And if I get a job in the meantime that allows me to enroll in health insurance, or I find some other option that's a less expensive option, I'm just going to protect myself and go ahead and make the election. So you go through all the work of the notice and, you know, putting them on a pending status and notifying the carrier of a potential reinstatement, and then that never actually make their first payment. But in the case when they do make their first payment after that 45-day period, it has to cover the full premium cost plus the 2% administrative fee from the date they lost coverage all the way through the currently due month. And that can be a chunk of money. You know, it can be 3 months of premium. And then after that, they have to be able to be allowed to make monthly payments. There's no requirement to bill them or invoice them or even send them anything. The law says it's the COBRA, the qualified beneficiary's responsibility to know when their payment is due. They do have a 30-day grace period to make that payment from the due date. But if they don't make it within that 30-day grace period, with few exceptions, they are going to be subject to termination with no chance for reinstatement. So if that hasn't completely boggled your mind, let's go ahead and talk about some of the common mistakes. So you're really good and you send all these notices and you got your calendar going and everything's perfect, but you find out that your notice you're sending doesn't have all the required language. Well, the Department of Labor has helped us out, and they do have model notices on the DOL website. And if you model your notice after their model notice, then it'll be completely illegal and you won't fall into that trap. The other thing is failure to include the spouse or adult dependents in those notices. Now, if the last known address that you have for a spouse is the same as the employee, then you can send one notice that's addressed to both of them. That's sufficient. If dependents are covered, and of course now they're covered until the age of 26, but those dependents live at a different address, or maybe that dependent is off at college, they should receive a notice too. And you really need to put a policy in place that requires employees to update addresses for covered family members, you know, quarterly or twice a year, or when there's a change. Because you are liable, potentially, if that notice doesn't reach the appropriate people. A third common mistake is accepting a short payment. You know, you're trying to be a good guy and the payment is short, or it's even past due, but you're thinking, oh, I don't want them to lose their COBRA, so I'm going to go ahead and accept it. Well, if you accept a payment that's short, but not significantly less than what's due, that's usually okay. But you have to provide the QB with a notice. And you have to give them a minimum of 30 days to make that payment whole. If you don't send that notice, and they don't make full payment, then that partial payment becomes deemed as full payment. You might be saying, okay, well, how do I know what a significantly less than what's due definition is? The federal government says an underpayment is deemed to be not significant if it doesn't exceed the lesser of $50 or 10% of the COBRA premium due. So again, accepting partial payments, up to you, but just make sure you follow that notice requirement and give them the appropriate grace periods. And by all means, don't forget about the COBRA participants at open enrollment. You're so busy giving out packets of information and the new plans and the new premiums to all of your current employees that you may forget about those qualified beneficiaries who, remember, have the exact same ability as any similarly situated active employee to make changes. Yes, at open enrollment, if you're on COBRA, you can change your election. They have the same renewal rights as any other active employee. And that means if you offer more than one plan, they can actually change plans. They can change who's covered. And because each qualified beneficiary has an individual right to elect their coverage, they can enroll family members in different plans if you allow that as an employer. And if you're adding a new benefit to your offerings, the QB, even though it wasn't available when they had the qualifying event, they can elect to enroll in that new plan because they get the same rights at open enrollment as any other, quote, similarly situated active employee. And then one other thing that you may or may not run into, there are employers out there who actually help pay for all or part of the COBRA premium. You just want to make sure here, if you're offering payment of COBRA premium as part of a severance package, that you don't run afoul of the Section 105 regulations. And one of the ways you can avoid running afoul of those regulations is do not pay the COBRA premium on behalf of that person. Rather, make the COBRA premium subsidy part of their severance package and have them make the payment. If the payment comes from them to the carrier, you're much less likely to run afoul of any regulations. And so those are 6 potholes I find. That if you steer clear of those, pay attention to all the language requirements and the timeline requirements, that you send out the appropriate notices, you're going to be all right. And while COBRA is not necessarily fun, there's rules around it, and if you follow the rules, you're probably going to be okay. So Matt, that's about all I've got, and if there's any questions, that would be wonderful.
We certainly do have some questions. So let me conclude the webinar, and then we'll get to those. I think first and foremost, Terry, thank you so much for taking some time to join us today. Very helpful. I think quick summary from my point of view, we absolutely, I think the last section on mistakes was very helpful. Being familiar with all qualifying events, being aware of deadlines and not to miss deadlines, not including a spouse on notices, making sure to treat individuals on COBRA exactly the same as you would treat other employees, active employees that are eligible for benefits. So thank you for that. So let me go through a few questions that have come in here. Hang on a second. First question was, how do you do with this? This was a couple of different variations of this one came in, and it was back when you were referring to the calendar year and calculating full-time equivalents. I think a lot of folks do their employee census when it comes for open enrollment time. And if open enrollment happens to be mid-year as opposed to calendar year, does that change any rules for COBRA? If I'm doing mid-year open enrollment in April or September or something like that, does that change any of my counts? Because I think the thing is we're getting the census report at that point in time on who's eligible for benefits. Does that make sense? So maybe you can comment on that.
And the answer is no. It doesn't make any difference. The COBRA eligibility determination would still be based on the prior calendar year. Would it make a lot more sense if the federal government said base it on the prior plan year? Yes, but that's not what it says. So you do go back to the previous calendar year and make those calculations. And, that then, even though your plan is a mid-year plan, you're going to be subject to the COBRA requirements, as I said, in January of every year. So, that could, for a mid-year plan, create some confusion. I understand, but that's the requirement.
Got it. Here's another one. If an employee is currently enrolled in health benefits through their employer, but on the next open enrollment, they decide not to enroll because they're covered by a spouse now, does the employer still need to send the general notice to this employee? So I would take it that they're currently not enrolled in any benefits because they're covered. They elected to or they declined due to being covered by a spouse's plan.
Yeah, if they decline due to being covered by a spouse's plan. So if I understand it, last year they were covered under this employer's plan. They got maybe a better deal by becoming a dependent on their spouse's plan. So they voluntarily, at open enrollment, decide not to continue. Then I would say, if you want to have an abundance of caution, you can send a notice, but this was a voluntary action during open enrollment by an employee to no longer participate in your plan. And so I would say, it's not as big a deal, but again, like I said, under an abundance of caution, you can send them a notice. It's, it's going to be wasted paper and wasted postage because they've already decided they're going to enroll in their spouse's plan, but at least you've covered yourself.
Got it. Okay, a couple more here. What if a qualifying beneficiary hasn't selected COBRA yet, but goes and sees a doctor and pays out of pocket in the time allotted? I think you went through this example a little bit. And then in the time allotted, will they be reimbursed? Should they select COBRA a couple weeks later? Should they elect in?
Yep.
Yeah. We went
because remember
there a little bit. The 45, 60 day, 90 day.
It's confusing. Mm-hmm. But yeah, if they elect COBRA, their coverage is retroactive back to the date they lost their coverage. So they would then have to file a manual claim. They paid out of pocket, file a manual claim. It might simply be against their deductible, but the carrier would have to then process that manual claim just as though they were enrolled on the date that expense occurred.
Perfect. Another question on calculating full-time equivalents. And again, if you haven't already downloaded the presentation, it is an attachment, and there's that slide with the calculation formula for full-time equivalents. It's an average, but the question, for you to comment on, Terry, when calculating full-time equivalents, do you base it on the employer's definition of full-time employment?
Yes. Yep. And that's where, it's different than ACA. But yeah, it's the employer's definition of a full-time person. So if your definition of a full-time person, and I'm not familiar with all the laws in all the states, but if your definition is a 40-hour person, then that's what you use. So that becomes the number of hours. You divide the hours worked by your part-timers to come up with how many full-time equivalents they're equal to.
Got it. And one final one that just came in, are union employees included in the COBRA count?
The answer is it depends. It depends on the union contract and the union agreement. Sometimes unions have their own, COBRA-like solution. So my answer would be to, double check with your union representative and find out if they're expecting you to offer COBRA or if they've got some other, option.
Good deal. Well, we've been going for close to an hour here, so I'm going to conclude things. So just real quick, we'll leave the contact information on the screen, but both us here at Payroll Systems would welcome a continuation of this conversation. There's an email and a phone number there, as well as Terry. He's gracious enough to continue this conversation, and his email is on the screen as well. So feel free to send questions. Like I said, download the presentation today, and you will be notified that the actual recording should be available probably late today or tomorrow as well. And you're welcome to share that with others in your group that have not or didn't have time to make the presentation today. So thanks again, everybody, for joining us. Like I said, I'm going to conclude the webinar. We'll leave the contact information up on the screen for another minute or two and let everybody get on with their day. Thank you much.